Good afternoon and welcome to the fourth day of the Dublin Economics Workshop Annual Conference, in which we will discuss the question, how can policy aid the recovery? Whilst it might seem a little premature to be discussing this question, given that we are still in the throes of the COVID-19 pandemic, it is perhaps timely, given that the focus up until now has concentrated on health aspects. Perhaps now it is timely to direct our attention as to how to get world economies moving again after long periods of lockdown. We have a broad range of perspectives today, a global perspective from the OECD, a central bank perspective, a perspective from our own Department of Public Expenditure, and very importantly, the perspective of the private sector. We welcome you, our attendees, our old friends who have attended many conferences over the years, Ítach Siva Ekáil Arís, and to those of you who have not attended our conferences before, Tá fáilte roimh isteach, and we hope this is the first of many conferences with us. We encourage you to participate in our discussion through posing questions through our Q&A facility, which you will find at the bottom of your screen. I will pose as many questions as I can to our speakers after they have all finished their presentations of approximately 10 to 15 minutes each. The slides from today's session, along with slides from all the sessions this week, will be available on our website, dublineconomics.com. And so to our first speaker today, Mr. Luis de Mello. Luis is Director of Policy Studies Branch at the Economics Department of the Organization for Economic Cooperation and Development. He has held senior positions at the OECD, including Deputy Director of the Public Governance Directorate and Chief of Staff and Counselor to the Chief Economist. Prior to joining the OECD, he worked as a senior economist at the Fiscal Affairs Department of the IMF and as lecturer at the Economics Department of the University of Kent. Luis, the floor is yours.
Thank you very much, Kieran. It's a great pleasure to be with you today, to be participating in this event. Unfortunately, it's not possible to be in Dublin in person, so hopefully I'll be able to do that when we can. Also, a great pleasure to be sharing this panel with Sharon, with Danny, and with Minister McGrath. If you bear with me, I will try to share my screen because I thought it would be useful to share a few slides with the participants to illustrate some of the facts that I would like to highlight today. You mentioned, Kieran, a very important aspect of the conversation now is that as we see signs that our economies are beginning to recover, it's important then to be one step ahead and think of what can be done now to already put our economies in a better footing as we come out of this crisis than probably we were before COVID-19 hit us. So I'll just share my screen now and show you a few of these charts. One important point that I would like to make has to do with COVID-19 itself, the nature of the shock that has hit us, and how it is accentuating to some extent some of the challenges that we were already facing before the crisis. Then I will move on to basically look at the future and see what policies, what we can do basically right now so that we can cope with what I usually refer to as a tale of two R's, so that recovery can be strengthened through this moving from rescue to restructuring. So the key operative words here I would say is recovery, rescue, and reallocation. On COVID itself, if you look at the numbers, I mean, I don't need to repeat them, but the global economy in the second quarter of this year contracted vis-a-vis the last quarter of 2019 by about 10%. So a 10% drop in one quarter relative to end 19, which is a fairly dramatic number, one that is very hard, thank God, to see in normal times. In some of the countries in the European Union, for instance, if you take the UK, just next door to you, or Spain, the drop was upwards of 20%. So very huge numbers and very asymmetric across sectors in our economies. If you look at this chart, basically what we tried to do there was to look at the share of employment in the hardest hit sectors of the economy, sectors that require a lot of person-to-person interactions as opposed to for instance, goods that basically don't require the same type of interaction. So basically transport, arts, entertainment, hospitality, personal services in general. And then you see that in this set of countries that you can see there in the chart, we are talking about 13% of employment in Germany, about 20% of employment in Korea. So lots of people being affected directly by virtue of being employed in the sectors that are hardest hit by the pandemic. Another interesting feature of this crisis is that many of the hardest hit sectors often employ vulnerable workers, workers that are on temporary contracts, that work part-time or are self-employed. So workers that are at the greatest risk of being laid off or to find themselves in inactivity as a result of a prolonged period of unemployment. So here you can see on average at the OECD, for all the sectors that you can see on the screen, about 40% of employment in the hardest hit sectors is accounted for by those non-standard workers, if you want. So two very specific features of the COVID-19 crisis that one has to bear in mind when thinking of policies to address this. And this is taking place on top of what I mentioned before, or referred to before, as pre-existing challenges. Take, for instance, productivity. Productivity has been slowing down in our economies over the last 2 to 3 decades. And a lot of this slowdown has to do with a drop in total factor productivity. So the overall efficiency of our economy that is not growing as fast as it did before. This is a big challenge for our economies because we know that future growth, potential growth, depends on the ability of economies to operate efficiently. So this productivity slowdown is not a good sign for, or doesn't bode well for future growth in our economies. And you see that this is the same picture in Europe as it is across the water in the United States. Another pre-existing challenge that we're facing is a drop in business dynamism in our economies. What do we mean by that? Well, entry rates at firm level, or the speed at which firms enter a given market, or the speed at which jobs are reallocated within sectors. Both indicators show a gradual decline in dynamism. There is nothing inherently wrong about a fall in dynamism. For instance, maybe there is less entry and there is less reallocation because the economy is doing a better job at matching workers to jobs. But it will be very difficult to reconcile falling dynamism with the drop in productivity that we are seeing. So it's not so much a benign story about better matching, but one that has to do with the fact that our economies are becoming less dynamic, hence our ability to make sure that productivity is diffused well across sectors. I mean, that is not happening the way it used to do. So basically, COVID hit us in a very differentiated manner across sectors, some of the sectors involving vulnerable workers, and at the same time compounding these pre-existing trends in our economies. So where are we now? Well, a lot has been done. Governments have taken very decisive action at the onset of the crisis. Lots of programs to basically shield companies and workers from the hardship of the crisis. We saw across the OECD area, countries, basically governments guaranteeing loans to support enterprises. A lot of programs that have to do with payment forbearance of rents, of loans, and so on. And importantly as well, lots of schemes to make sure that workers are retained in the jobs where they are. So the famous furlough or job retention schemes. to give you an idea of the extent of job retention schemes. If you just look at this chart across a variety of OECD countries, you see that programs have been very substantial in a number of countries. These are basically shares of dependent employees, so shares of workers in different sectors that are participating in job retention schemes. So fairly widespread in many parts of the world, whereas in other parts of the world, the option was basically to increase the generosity, the duration, the magnitude, the replacement rates of unemployment insurance, for instance. What is interesting about the job retention schemes is that they make sure that if the shock that we are facing is a temporary one, that basically workers can remain attached to the jobs they are, the cost of firing is reduced, the cost of losing capital that is associated with an increase in unemployment is reduced. So basically you can make sure that you're protecting the workers involved, but also making sure that the economy can withstand the shock without too much disruption to the attachment between workers and firms. But the issue is that while this measure is important in the short term, there are tensions here. There is a tension between preserving jobs, so freezing our economies, if you want, in the short term, and this longer term reallocation that will be needed should the shock be longer than we expect, or should it be so asymmetric that there will be sectors that will basically shrink over time, while whilst there will be sectors that will expand. So just to give an example of the situation, a program that was put in place in Australia, you can see there that unemployment separations had increased, the blue lines, and when the program was put in place, there was immediately a drop in separation. So through job retention, workers, firms basically benefited from that and reduced layoffs. You see that for the firms participating in the programs on the right, and you see that for firms in general. But the issue is that the program didn't affect only separations, it also affected hires. You had a reduction in the number of people being laid off, but you also had a reduction in the number of people being hired in general in those firms. So that illustrates the type of tensions that I was referring to. A falling hires is basically means that the economies are less prepared than to employ more people, to grow, and to reallocate those workers across sectors, from sectors that are shrinking towards sectors that are holding up or expected to basically come out of this crisis more strongly. So this type of tension is one that policymakers need to bear in mind when designing a second generation of policies that will allow them, when the recovery takes hold, that will be able to deliver this needed reallocation of resources. Another example that I wanted to share with you, which has to do with, well, basically what can be done to deal with this tension. Let me just refer to some work that we did at the OECD that basically tried to look at the re-employment probability of those workers that are displaced. So basically the idea is, you lose your job, how likely it is that you will be able to be re-employed, to find another job as a result of government intervention in active labor market policies. Meaning what? Meaning basically more emphasis on retraining, more emphasis on the vocational education and training, and so on. So what these numbers show is that when the government invests in active labor market policies, there is an increase in the probability of reemployment, and that probability is higher in sectors where barriers to entry are low. Much higher in sectors where there is that there is more labor mobility, if you want, than in sectors where barriers are high and that mobility is lower. So it gives you an example of how policy packages can be put together in a way that benefits workers that may be in unemployment as a result of this crisis. So greater investment or emphasis in active labor market policies, while at the same time also trying to make sure that business dynamism increases that there are fewer obstacles to mobility in the sectors of the economy, those should go in the same direction of making sure that we boost the dynamism, we enhance that through reforms that will allow this smoother transition towards a new situation or a new structure in our economies that will be more consistent with productivity growth over time, more consistent with dynamism over time. So I just wanted to share this example with you. I know, Kieron, my time is up, but also to end with this note that we are seeing some signs that the economies are coming back, some signs that the recovery is taking hold. So it's time to start thinking about the future through a variety of reforms that will then help us deal not only with the effects of COVID-19, but also address those issues that were there before that I mentioned at the beginning, low productivity growth and so on. So look forward to the Q&A later on. And again, a great pleasure to be on this panel with all of you. Thank you.
Thank you, Luis. Thank you for an excellent presentation. Next up, it is my great pleasure to welcome our second speaker today. She's a long-time supporter of the conference, Miss Sharon Donnery. Sharon was appointed Deputy Governor of the Central Bank in March 2016. She's an ex officio member of the Central Bank Commission and the Governor's alternate on the Governing Council of the ECB. Sharon is responsible for leading the Financial Stability, Economics and Statistics and Financial Operations Directorates of the Central Bank. Sharon was acting governor from June 2019 to August 2019. And now I invite Sharon to deliver her presentation.
Well, thanks very much, Kieron. Real pleasure to be here and good afternoon to everyone. I'm afraid I have to admit that I'm such a long supporter of the DEW that I remember when we used to go to Kenmare. But I have to say it's really nice to be here. For me, a key issue with the DEW has always been the focus on policy. And I think it's really nice that we can get together this year, even in the challenging circumstances, given just how important policy is at the moment. And I think that's probably a good segue into the things we're going to discuss this afternoon. Now, when Kieron made his introductory remarks at the very beginning, he talked about the timing of discussing policy and the recovery. And I think an interesting aspect for us here at the bank has been that from the very beginning of this issue emerging earlier on in the year, we have thought about policy as being about stabilising the situation, mitigating as best we could the economic effects of what was obviously a public health crisis, but also stabilising the economy so that we could prepare for the recovery when it would come. And we've seen that as a very important, I think, part of our own role and the role of the other central banks that we work with globally. So today I'm going to talk about two things, mostly the Irish economy first, in terms of our assessment of the initial effects of the pandemic, and then with the theme of what we're talking about at this session, the role for policy and particularly the aspects that we're involved in here at the Central Bank. So I do have some slides to help us with the data, so hopefully Maeve can get the slides going now, if that's okay, and we can go to the third slide, which really is just there to highlight, I suppose, the severe effect that COVID has had on the Irish economy. And you can see here on the left something I'm sure people will have seen earlier on in this week, which are the CSO figures from the quarterly national accounts. And we have on the right here the scenarios from the Central Bank's last quarterly bulletin, which we published during the summer. I think an unprecedented set of analysis in terms of how challenging it was for our staff economists to do that work. And the first time we had published rather than forecasts scenarios, and you see here the baseline and the severe scenario. And of course, it doesn't paint a pretty picture. But if we look on the next slide, I think maybe one positive to take out of it is that if we look at, for example, monthly employment data on the left, we can see that we are closer to the baseline scenario rather than the severe scenario. And that comes from the most recent data that the CSO has produced. But we see on the right here, I think, a common theme for the pandemic and also a common theme for some of what I'm going to say today, which is the really huge variation across the sectors. And in this case, you can see the significant effect on accommodation and food and the arts sector in particular. Of course, this chart on the right also shows, I suppose, differing aspects about the causes of what's happened as well. So in some cases, the job losses that we've seen in the economy are the result of the restrictions that have had to be introduced. In some cases, the job losses are actually a result of a sharp decline in demand. And in fact, the majority of the losses, which you can see here, are in the accommodation and food sector, in fact, took place in the weeks prior to the 27th of March. So it's also interesting, I think, to note that those job losses occurred at varying speeds. And the data that we're seeing now in terms of job restoration would also indicate that the restoration is happening at various speeds. And another, I think, distinct aspect in this kind of heterogeneity is that, of course, we know that younger workers and those that are in the lower quintiles of the income distribution have also suffered the largest job losses, and in other work we're doing at the bank, which I don't show here, we're also seeing significant regional variations. So all of these kind of differences, I think, are a significant aspect of the pandemic. And we see this again if we look at the next slide, which shows the sectoral variation in the recent income tax outturns, and there has been some public commentary around this. And of course, the reason for this is that the employment loss has been greater in sectors that typically make a lower amount of net deductions compared to workers in sectors which contribute more to the tax level. And in fact, it's also interesting in looking at these sectoral data that you can see that employment levels, for example, between Q1 and Q2 for high wage sectors like ICT and finance, which typically pay about a third of their gross pay and tax, actually increased over this time period. Whereas for sectors like accommodation and food, where a much lower percentage of wages is paid in tax, there was obviously a very significant decline in employment in those sectors. And now if we look at the next slide, one of the significant issues for the bank in understanding what's going on in the economy has been lags in data. And so we've done quite a lot of work over the last few months in trying to build a real-time picture of the Irish economy. We've published quite a lot of material, which I hope people are finding helpful. This particular set of data on the left shows card spending, and we were using this to try and give us some insights into consumption. You can see now, of course, the card spending has recovered somewhat and is now back to levels above August 2019. But of course, ATM transactions remain significantly below. And if you look on the right-hand side here, you see the retail sales index, where there has been a strong rebound. But again, if you look at the underlying data, we see that this is very uneven. There's been a very strong performance in some sectors like hardware, white goods, electrical, and so on. In fact, we think some of that is probably related to expenditure on materials needed for working from home. And some of that bounce back has been compensating for what is very weak performance in other sectors, like obviously bars, but also certain aspects of retail like books and department stores, and also effects we see like those in city centres, where city centres have been significantly affected by the restrictions. If we go to the next slide then, we'll also see, I think, that although there has been some recovery in consumption, one key issue that I think we need to monitor quite closely is around consumer sentiment, which is lagging quite behind. And this, I think, is quite important in how we think about the recovery and the future and how people's behaviour might evolve over the longer term. In fact, recently at the central bank conferences, which some of you will know are held in Jackson Hole over the summer, there was a very interesting paper on this, looking at the possibility of scarring effects in terms of behaviour of consumers into the future. On the right-hand side, we also see, I think, a significant dimension of these sentiment effects and also the possibility for longer-term changes in how consumers behave. It shows how deposit growth has evolved over the course of the pandemic, and we certainly think that these two things coupled together, so this significant precautionary savings and how consumers feel about confidence in the economy, could have a significant effect on the future in terms of whether that precautionary saving behaviour, for example, persists, or whether that ultimately turns into consumption and so on at some point down the line. Now the next slide shows another aspect of these so-called real-time indicators that we have been using, these though on the credit side. People will be familiar, I'm sure, that we've set up the Central Credit Register over the last number of years, which all lenders must now report to in terms of loan applications and loan demand. And we see here, I think, some strong distinctions between loan applications by individuals, which are on the left, and credit inquiries for loan applications on the right, which are for companies. And again, I suppose you see this distinction in terms of how this has evolved over the course of the pandemic, with some recovery on the side for the individuals, but demand, I suppose, much more muted on the right in terms of SMEs. And of course, we know that in the Irish economy, SMEs are really crucial for employment. And I think one of our key policy objectives for the country is to avoid a situation where otherwise viable businesses go out of business over the course of the next few months. Now, if we turn to the next slide, I'll talk a little bit more about SMEs, although I'm quite sure Danny will want to speak in more detail about the experience of firms. But I think, as I said, we really see SMEs as being crucial for the recovery, given the important role that they play in employment. If we look at data that we would have seen before this crisis period, we see that the majority of SMEs entered the crisis period with relatively modest liquid assets, and also with a very limited amount of outstanding bank debt. And while there have been significant supports, I think we feel these are quite important, given that there are likely to be quite significant liquidity needs for SMEs over the coming months. And some of my colleagues at the bank have published analysis over the last few weeks and months about what those liquidity needs might be. We have, of course, the various schemes that are listed here. The wage subsidy scheme, I think, being a particularly important element of the support that has been provided to SMEs, but we'll also be looking carefully at how the credit guarantee schemes and the other lending schemes, for example, evolve over the coming months. Now, other work we've been doing at the bank has also been looking at how payment breaks have been implemented, not just across SMEs, which are mentioned here, but also across the mortgage books. But some of the data we have show already that around a quarter of SME balances had a payment break at the end of May 2020. And we'll be continuing to look at how this evolves as maybe some of those payment breaks come to an end, and SMEs that need a more significant restructure or a longer term restructure over the coming months have to engage with their banks to put those in place. But I think the general story from what we've seen in terms of SMEs, it really emphasises the importance of targeted support and the policy mix that's put in place in terms of supporting SMEs over the coming months. So the next slide shows again, I suppose, this theme of the heterogeneity of what's going on. Not dissimilar, I think, to what happened after the financial crisis. We see this very strong support coming to the economy from exports. And I think it's fair to say we think the external side of the economy has probably held up a little bit more strongly than was expected. This was very much driven, I think, by the contribution of chemicals and pharma and so on, and also computer processes and business services exports. And as I said, this was an important feature of the recovery from the last crisis, and something that we will continue to look at closely over the coming months and years. Then the next slide deals with, again, an issue people will be familiar with in Ireland, which is around headline GDP and how it can mask significant other issues that are going on at a more underlying level in the economy. And the chart on the left shows the effect on GDP compared with our European colleagues, but on the right shows the effect on consumption. And you can see, obviously, this very significant difference. Consumption declined by over 20%, which I think is the largest quarterly decline in this series so far. Although I think we would say that decline was maybe slightly more moderate than had been expected based on what we had seen in terms of the retail sales information we'd seen, and also on credit card spending. So one thing we do with all of these data in the bank is to try to put them into a single indicator in terms of the business cycle, and you can see that on the next slide. Colleagues here at the bank have published, again, analysis in relation to this. So you can see this strong bounce back in June. This is largely driven by retail sales, by the labour market and some of the soft data indicators we use. And while there's some positive news in that chart, I think we can see that it's still far from the pre-COVID level. It has also, interestingly, passed through the trough level of the 2008 economic crisis. Our estimates for July would suggest that we are on this path for a continued recovery, but there is a strong slowdown in the rate of improvement. And the soft data for August, I think, would confirm that. So this is something that we will be monitoring closely. So if I was to wrap up our sort of assessment of the initial effects of the pandemic in terms of the economy before I speak for a few minutes about policy, I have a summary on the next slide there. I think everybody agrees it's been a very severe shock. The impact obviously varies very significantly across the sectors. There are some signs of recovery when we look at consumption and credit demand, particularly for individuals. Consumer sentiment, though, remains low, savings remain high, and these two factors together could combine to have long-term implications. Exports have held up more strongly probably than were expected, and as we saw just on the last slide, the business cycle indicator does suggest a continuing recovery, but there is some slowing down of improvement. So what about the role for policy? So if we look at the next slide, if we look overall, sorry, the next one after that is the chart. If we look at overall, there's obviously been policy action taken by central banks and by governments. There's also been policy action taken domestically and at international level. And I think what we've done here is try to see the combined effect of these. And our initial estimates suggest that the scale of decline in output in 2020 would have been 4 percentage points more than if these policy actions hadn't combined together. And again, some of my colleagues published some work on this in the summer. So if we turn to the next page, I'll talk a little bit more specifically about the policy response from a central banking point of view. Now, first on monetary policy, I have to issue a disclaimer. I've obviously just come from the meeting of the Governing Council, which took place this morning, and the press conference at the ECB will start very shortly. So I'm not going to talk about monetary policy other than to say that obviously there was a comprehensive package of policy measures already put in place. I think an interesting aspect, and Philip obviously will talk to people more about that tomorrow. I think an interesting aspect for us here at the central bank has been the use of macroprudential policy. We've put significant efforts in the last decade into using macroprudential policy to strengthen the resilience of the banking system and to make sure that the banking system was stronger and better able to absorb shocks. And I think we've seen that the banks obviously had much higher capital and liquidity buffers precisely for a crisis were one to emerge. And people might recall that in March of this year, we released one of those capital buffers, the so-called countercyclical capital buffer, which in fact is designed to allow banks to use additional capital to absorb losses, but also importantly to lend into the real economy. On the next slide, then, I'll talk just briefly about the mortgage measures. Again, this has been an important aspect of our macroprudential toolkit. They're designed to build both bank and borrower resilience and have been in place since 2015. We're doing some analysis on the mortgage measures at the moment, obviously in preparation for the review, which we always do in the autumn. But I think one interesting aspect that we can see already is that loans drawn down since the introduction of the mortgage measures were on average less likely to have needed to avail of a payment break. We've had a number of other policy aspects in terms of microprudential policy, or the policy in terms of how we supervise individual banks, allowing banks to use their capital and liquidity buffers as well as operational flexibility. There's obviously been a significant focus of the effect of the pandemic on consumers in terms of, for example, the operations of payment breaks and how that feeds through into the CCR. And then, I mean, there are obviously issues with significant numbers working from home and so on, and making sure that the firms that we supervise are operationally resilient as well as financially resilient. I think we have obviously also been looking at the fiscal situation very closely, and I think have been clear in saying that we think that the fiscal supports that have been provided have been very much necessary and warranted. But I think we are conscious that the current rise in the government deficit and debt ratios, while they're affordable, are obviously something that we have to think about in the more medium term in terms of how we can make them sustainable, and that has been a feature, I think, of some of our work over the last few months as well. And maybe building on that point about resilience in the times ahead, not just in terms of the fiscal position, but if we turn to the next slide, while we're obviously still very heavily focused on dealing with the current challenges, I think we do also have to be conscious of the medium-term resilience of the economy. I mean, we've all spoken many times about some of the vulnerabilities that we have in Ireland in terms of being a small open economy, global tax changes, climate change and so on, and none of those longer term challenges have gone away. So we do have to be conscious, I think, of that long-term resilience and how we design policy at the moment. Clearly much depends on the path of the virus. I think in thinking about that, we need to consider carefully the risks of labour market scarring and the possibility of long-term effects. We've seen many different divergences in some of the data that I've shown there, but I think people are well familiar with them in terms of sectoral and regional different divergences, which need careful consideration in terms of how policy support is provided in a very targeted way. And then, I mean, we discussed it here at the DEW yesterday. It's obviously highly topical in the media at the moment, but we also have the challenges of Brexit, which I think the bank has been on the record for some time in saying that, you know, any deal, even if it were to come, would obviously not be as good as the status quo, and we do have to prepare for that. So many challenges ahead. As I said at the very beginning, I do think certainly from our point of view, policy has played a really important role in mitigating some of the effects of the crisis, and we hope in preparing the path for the recovery that will be ahead. So I leave it there, Kieran. Thanks again for the invitation, and I look forward to the questions. Thanks.
Thank you very, very much, Sharon. Indeed, Sharon is correct. We used to decamp to Kenmare in beautiful Kerry this time every year, so much so that we became known as the Kenmare Conference. But now, of course, our home is in Wexford in the sunny southeast. So now we are down in Wexford. Hopefully, this time next year, we will be back in sunny Wexford again. We had scheduled the Minister next, but he's slightly delayed. So our next speaker will be Mr. Danny McCoy. Danny is Chief Executive Officer of the Irish Business and Employers Confederation, a post he assumed in 2009. Prior to joining IBEC, he was a senior economist at both the Economic and Social Research Institute and at the Central Bank. He has held lecturing posts at Dublin City University, University College London, University of Oxford, and at Trinity College Dublin. And he's acted as a consultant for the European Commission and the OECD. He is a member of the National Competitiveness Council and the National Economic and Social Council and the Export Trade Council. Danny, we welcome your presentation.
Thanks very much, Kieran, and appreciate following on from Liz and Sharon there. I don't have any slides, so because the guys actually, I think, captured the salient points there, the stylized facts of what we're going through. I'd like to offer maybe a business perspective, and particularly to dissect the GDP numbers. So the first thing to say is that the old adage, if you haven't been to Shanghai in the last 10 years, you haven't been to Shanghai. If you haven't actually been in the Irish economy in the last 5 years, you haven't been in the Irish economy. And actually, that's one of the things that I think that a lot of the commentary, both domestic and international, fundamentally missed the shifting patterns in here. I think it's probably best exemplified by the controversy over the use of GDP as a measure. GDP may not be perfect, but is actually capturing the essence of what we see in the business community, which is that move towards the intangible asset base, which has effectively given rise to over 100% growth in GDP. So the drama of that story means that the economy is potentially in a very different place when it got hit by COVID than most other jurisdictions. I think the national accounts in the last week proved this point dramatically, where we see this K-shape in the economic performance between the sectors that are booming. We see that we're overexposed to those sectors, particularly in tech, in biopharma. At the moment, our medtech sector is potentially subdued, but they're pretty confident and they're certain that medtech is going to have a boom as well because we've had postponement of elective surgery. Food and drink has also stayed up very dramatically. They may have different channels to go through to get food and drink into the households, and they may be margin constrained, but fundamentally it is operating. So the narrative about reopening the economy is very much captured by the very visible closed down sectors in hospitality and tourism, but fundamentally this is an economy that's actually up and open. It has been dislocated and there are issues around that. But fundamentally, the data doesn't lie. And we see that from the exceptional performance in our public finances on the revenue side in terms of the income tax returns and the fact that corporation tax, which again, all commentators say is very vulnerable, true, but is now recurring and nearly into year 6 of this phenomenal growth. We could well see, if trends go true, that corporation tax may outperform expectations dramatically this year. I personally was of the view prior to COVID, that 2020 was potentially going to be a year equivalent of the very famous 2015 outcome for GDP. There are a number of reasons for that. One is 2020 is the year when the so-called double Irish ends. And we already saw in 2019 significant movement of corporate balance sheets into the Irish economy. And that's a base effect. And I think this is what's lost in a lot of observers. They know it and then somehow forget it. Firms invest, be it in machinery, equipment, or buildings construction, or in intangible assets like brands, patents, copyrights, for recurring income in the future. And the step change in our capital stock during the last 5 years is truly a global phenomenon. Like the run rate estimated by all of our organizations for 2019 for the investment by firms was in the order of 120 billion, 110 to 120 billion. Like, think about that. That's a run rate of over 2 billion euros a week. Like Intel, that great iconic investment, cumulatively over a 30-year period and now going through an incredible expansion, has been in the order of about a 15 billion cumulative investment, to put this phenomenon in context. And it is a stock of investment that gives rise to recurring income. Now, you can argue about the stability of the sources and so on, but it has happened, and it has shown its worth in the last couple of months. Again, I might be a little bit imprecise, but I think manufacturing from the results last week has grown by 18%. We certainly are seeing domestic sectors falling by 20%, and in aviation, much more dramatic and devastating. But it's still the case that our economic activity has fallen by much less than pretty much any other jurisdiction. And there's every chance that when you look back on the year 2020 from a future date, that a casual observer will not even see a COVID effect in the Irish GDP numbers in the future. So against that backdrop is we need to know and assess where we are, not in this kind of herd mentality of where Chicken Lick in the sky's fallen in terms of the economic performance. So this is not to deny the distress that is in those sectors who have been denied a living, particularly in the hospitality and tourism, but also in the tourism, it is the case that in many of our seaside towns, they're going to have experienced the record summer, because not alone are volumes high given the staycationers, the difference between an Irish family spending money on a night out is quite different to the tourist market that they may have been used to before. You're talking about an X factor here of anything up to 2 to 3. And I think that is evidence as well in what we've observed at the level of the household. We see from, again, the statistics, and Sharon mentioned some of that in terms of the credit card, but also on the savings, that 120 billion euros or so of savings by Irish households, again, must be, in international terms, somewhat of a phenomenon given the demographics. We're talking about having more than at least 1 month's headroom for the Irish family, given that our wages and salaries are about 100 billion. That's quite phenomenal, and in actually really stark contrast to our nearest neighbours in the UK. So Ireland's base effect here and the momentum that's underneath the economy, I think, is missing in a lot of the conversation that economists are having about how Ireland's experiencing COVID in contrast to other jurisdictions. This is, in my view, a chalk and cheese scenario. Let's just take the UK for a moment. Again, a lot of lazy commentary looking at the labour market phenomenon. Furloughing the workers in the UK is a very different way of approaching the problem than we did economically here. The furlough an employee is basically to keep the employment relationship, but lay them off temporarily, but they're still employees and so don't get caught by the unemployment rate number. Here, we didn't actually go that route. We did 2 different types of things. One, the temporary wage subsidy scheme allowed people to actually stay full-time in work, but still be subvented by the state with their salary. Or the alternative, the pandemic unemployment payment, which again at 350 euros was a factor of 3.5 versus the UK equivalent unemployment benefit, to allow people to actually leave their employment, so breaking that arrangement and fundamentally going on to the welfare system. This then explains the 26% unemployment issue in Ireland. And again, if you're just observing, you'd say, boy, that looked really bad in Ireland. Look at their unemployment rate, how high that went in contrast to other jurisdictions. Completely false reading. It was the strength of the public finances that allowed that level of subvention for people to stay at home, where up to 38% of the recipients of the pandemic payment were experiencing a pay rise during that phenomenon. So we've seen this huge pendulum shift of pushing resources from the state into the households. And now the households can't get those channels back into what might be called merit expenditure. So let's step back again. I don't believe that COVID has actually been a structural break at all in the Irish economy. Far too soon to tell, but the notions that what has changed is changed channels of getting people to deliver their output, doing it from a home environment as opposed to a workplace environment, or different channels for getting consumption to those households, bypassing some of the usual vectors of the public house to get your alcohol or for your congregation. But these are just the acceleration of some underlying trends, but there's no structural break in the economy, in contrast to some of the other graphs that we looked about earlier on, which would be suggestive on just an economist's casual observation of it, as somehow there were structural breaks occurring. So I think that's one of the kind of backgrounds that I think the economics community needs to discuss. I unfortunately haven't been able to attend some of the sessions this year, and may well be captured on other occasions. So therefore, in terms of the remedies and what we're trying to talk about today, is how do we ensure that some of these don't get compounded by measures that we take now and what may well be a false narrative, or applying a kind of a blanket approach to some sectors that actually don't need the triage here, and those that may need to be focused differently. Well, the first one is that it was always the case you're going to have to open up and see what the damage was. And I think fundamentally, the last piece of the jigsaw is not just the pubs, and hopefully we will see them open safely and that they won't have problems associated with it, but it's really about large congregations and events that matter to us in terms of be they music concerts or football events and etc. That's the kind of the last frontier on the opening. And that's really important as a sector, but it is in the last 5%, 95% of the economy is effectively open on the supply side, or potentially on the supply side open. I exaggerate perhaps a little. The main issue that people are worried about is where the demand will come from. And again, we have a number of obviously headwinds and potential uncertainties, Brexit being an example of that. But fundamentally, my central thesis here, from somebody who actually observes businesses day in, day out, and they aren't just statistics on the CSO when it comes to those investments. I've been in those companies. I see what they do. I see the level and scale of the machinery and equipment, is that this is an economy that has the capacity for recurring income and activity for quite a number of years to come, because the scale of the investment that's taken place over the last decade is such that we would anticipate that that sunk investment in sectors that remain hot and will do in globalization will give us that reoccurring income. Our problem remains the one we had in the first quarter of this year prior to COVID. We've managed to put too much money into the household sector, and the households have other demands. Their demands, though, are items that need to be provided by the public sector in terms of infrastructure, public infrastructure, housing, childcare, transportation, security. Certainly a big issue for us. Security, not just security of people, but also security of assets. Those assets I've talked about in terms of the investment, they also need protection. Physical protection, but also cyber protection. And so these are the kind of public good type features. We need, ironically, to get the pendulum back swinging from the households towards financing what people want. And the problem with COVID, I'll end at this point, is that the pendulum actually pushed the money rightly, given the shock to keep people to stay at home, has exacerbated that problem even further. The money has ended up very firmly in the household sector, and it's the government that's racked up the debts. And here comes the bravery piece. How is the government going to extract that money back from the households to deliver that which the households profess to need and want? I'll end at that point, Kieran.
Thank you very, very much, Danny. Thank you. To quote Yeats, and who would have thought this 9 months ago, all is changed utterly. I remind you, please, attendees, to get your questions into us through the Q&A function at the bottom of your screen, and indeed on Twitter You can find us at the hashtag DEW2020. Our final speaker today is Mr. Michael McGrath, TD. Michael is currently a TD for Cork South Central and is the Minister for Public Expenditure and Reform. He was elected to Dáil Éireann in 2007 and has been re-elected in every election since. Before going into politics full-time, Michael held senior positions in both the private sector and the public sector. As Minister for Public Expenditure and Reform, Michael is responsible for delivering well-managed and well-targeted public spending through modernised, effective and accountable public services. Minister, the floor is yours.
Kieran, the Minister just has a little bit of government business. I was going to suggest if you wanted to take maybe one question, and he'll just be with us in 1 minute. So perhaps maybe one question and then back to the Minister.
Apologies. Sharon, if you don't mind, one has come through from a US-based investor. How would you characterize bank behavior during this crisis? Viewed as the bad guys during the global financial crisis, would you agree that they have been good guys during this crisis? And if so, how should investors think about your allowing them to return to paying dividends?
So I'm very conscious that we have a regulatory role, so I'll be careful about what I say about which side of that argument the banks are on. But I do think maybe two things. So first of all, in general, banks and in particular the Irish banks obviously came into this crisis in a stronger position than they had been after the financial crisis. And as I said, we have spent quite a bit of time building up those liquidity and capital buffers and so on. And the banks have obviously been dealing with some of the many legacy issues that they had after the financial crisis. I think an important policy issue has been the use of payment breaks. They have been used widely by the Irish banks, but also by banks internationally. And I think we have to acknowledge that, you know, banks did a lot themselves to put those payment breaks in place. Clearly, regulators, not just ourselves, but other regulators also had an important role in making sure that they were being implemented in a consistent fashion and so on. And we did engage heavily with the banks in relation to that, and indeed other lenders, not just the banks. But they did, I think, put a huge amount of effort into that. I think they're reaching a critical juncture now in terms of how they think about those customers that will end those payment breaks and will move on to you know, the need for longer term restructuring and so on. I do think on dividends, it has been an important part of the regulatory intervention. I mentioned those capital releases that we have allowed banks to undertake. And I think we've been very clear that they have been allowed to ensure that banks can absorb losses and indeed can continue to lend, because it's important that we don't have this kind of amplification to the financial system through a significant decline in credit. I mean, we do obviously see some decline in credit, but we don't want to amplify that even more. So the prohibition on dividends and using that capital for dividends has obviously been an important part of that. I mean, as I said towards the end of my presentation, we do also, I think, have to think about post this crisis and the resilience of banks, which is important to build up again. I think I'll leave it there, Kieran.
Thank you very much, Sharon. Louise, if I may, there's a very pointed question to you, and it's the old chestnut, you know, and it's a very simple question put by one of our attendees. Is there a need to reduce regulation to increase business dynamism?
Thanks, Kieran. That's a very interesting question that goes to the heart of the work we've been doing at OECD for a long time. I would say that the short answer is in general yes. And why? Because there is a need to basically remove obstacles to the entry of firms in sectors, to basically, you know, to make sure that that there is that basically the entry of firms and the operation of firms in sectors is as seamless as possible. We see, and that is not basically you know, a conjecture. It's really based on empirical evidence that in countries where there are fewer restrictions in product markets and services, firms tend to be more productive, and there is a higher level of productivity for the economy as a whole. And that applies to a variety of countries and sectors. One example, Kieran, is that there is a big
camera here now. The camera's
states, for instance, about occupational licensing. We are in economies that are more and more based on services, more and more based on intangibles, as Danny mentioned. So that type of licensing that restricts the areas of the country where professionals can operate, the types of activities that can be performed, the costs of licensing and so on, those are frictions, those are impediments to this entry. So it has a direct bearing on the entry of firms, but also a direct bearing on the exit of firms. So we see also a correlation between restrictions to entry and exit that are in a way associated with this loss of dynamism over time. So yes, the more the pro-competition, the regulatory framework in product, markets, and services in a country, the better the performance of that economy in general.
Thank you very much, Louise. So now, after a slight delay, we will now take the Minister, Minister Michael McGrath. We look forward to your presentation. Thank you.
Kieran, and sincere apologies for the delay. The Oireachtas is functioning down at the convention centre on a temporary basis, so I had to make my way down there for some votes and back up to speak to you here online from my office. So apologies for the delay, but I am delighted to have the opportunity of taking part in this year's workshop, and I just want to commend all of the committee and the organisers for putting together a fantastic event again this year, albeit with a difference, obviously, and you have a really strong lineup of speakers. So I'll speak about, from the perspective of the Irish Government, the policy response so far, but more importantly, the policy framework and the ideas that we have for the repair and rebuilding of the Irish economy to deal with the fallout from COVID-19. And it's so important that we have forums such as this to tease out with academics, with economists, people with an interest in economic research and policy, that we can have an open debate about the choices that we face and the challenges that our country is facing at this time. And the arrival of COVID-19 in Europe earlier this year has led to unprecedented changes in life here in Ireland and around the world. And it's been hugely challenging, as we all know, for workers, for businesses, communities, and governments right throughout the globe. And since the onset of the crisis, the overarching objective of the previous Irish government and the new government that came to office at the end of June has been to protect public health, to save businesses, and to support employment. And policies have been put in place to give effect to those overall priorities. And these policies have been crucial in stabilising the economy thus far. And as the Taoiseach has said on a number of occasions, our goal is to protect lives, but also to protect livelihoods. And I am very clear on one thing, and that is that as a society and an economy, we have to learn how to live with this virus. While there has been lots of speculation as to when an effective treatment or a vaccine might become available, the truth is that nobody knows for sure. And so the assumption we have to make in planning for the future is that COVID-19 is here to stay for the foreseeable future at least. And this represents an enormous challenge for all of us, people that have already borne a heavy burden from the virus and have made many sacrifices, both socially, economically, and personally, may very well have to continue doing so for the foreseeable future. And we are asking a lot of people to bear with us and to follow the public health advice, but we must do it. So we need input from economists and academics and business leaders and civil servants to tackle some of the real challenges we face, and especially the need to balance public health measures with a functioning economy. And it's not a binary choice. The reality is that we have to do both. The emergence of COVID-19 and the threat that it could escalate quickly required decisive action taken in rapid form to protect human life and also the functioning of the health service. And early emergency economic measures took the form, as you know, of the wage income supports. And I want to acknowledge the contribution of Danny McCoy and IBEC to the debate at that time, and the proposal that they made for a wage subsidy scheme, which I think had a significant influence on the government at the time to bring in the scheme in the form that it was introduced. Also, liquidity supports and grants were introduced. The wage subsidy scheme and the pandemic unemployment payment were crucial in supporting people through a very, very difficult period in emergency circumstances. Well over 1 million people in our country were being supported by state income supports, from job seekers allowance to the PUP payment to the wage subsidy scheme at one point in time. And just to give you a sense of the scale of this, before COVID-19 struck, the social welfare vote or budget was expected to be in and around 21 billion euro in 2020. And now sitting here today, we expect this to be over 30 billion euro in 2020. That does include the cost of the wage subsidy, as well as the job seeker supports that our government has provided. So it's just a simple snapshot of the scale of the crisis that the government and society has had to deal with. The stimulus package announced back in July, in the first few weeks of the life of the new government, committed to extra spending of 4.3 billion and tax measures of almost €1 billion. And the policies in that package focused mainly on helping struggling SMEs and getting people back to work. We all know what the main elements were, and there isn't any need to go over those again. But giving certainty about a new wage subsidy scheme out to the end of next March, expanding the Restart grant and increasing the amount, the commercial rates waiver to the end of September, the ability to warehouse tax liabilities for SMEs, accelerated loss relief, the ability to reclaim back tax paid on profits last year on the prediction of losses being made this year. And just this week, we have officially launched the new €2 billion credit guarantee scheme. We've also outlined a whole range of programs on the labour market side and activation measures. We have the Stay and Spend initiative. We have the extra €500 million in capital investment, which we want to see spent before the end of the year, all with the view to supporting jobs and kick-starting activity across the economy. So the scale of the response from both the last government and the new government has been really significant, and we are prepared to do more. And that is one of the key messages that I want to convey to all of those taking part in this workshop today. Our approach to this economic crisis will be investment-led. Rather than slashing capital expenditure, for example, which happened a decade ago when money simply wasn't there, we will be increasing it. Next year, we will spend over €9 billion on capital investment throughout the country on vital projects in housing, transport infrastructure, climate action measures and education, just to name a few. We will shortly announce a detailed review of the National Development Plan to ensure it is properly aligned with the priorities of the new government and that it is consistent with the overarching objectives of Project Ireland 2040, that all of our policies are pointing in the one direction so that we can get the best synergy and the best results. So the revised National Development Plan, which will be adopted next year, it will set out a trajectory of capital investment for the next decade, and individual departments will be given their own capital allocation for the next 5 years. So that will give ministers the certainty that they need to plan and to progress projects through the various stages of the system. And it will also give confidence to the construction sector that the flow of capital spending by the government is secure and will continue. The budget that Minister Paschal Donoghue and I will present on October the 13th has been framed against an unprecedented level of uncertainty. In relation to COVID-19, we have to plan on the basis that it will be with us through next year. The estimates process that I am now engaged in with different line ministers is a particularly complex one this year. To give you an example, at the beginning of 2020, it was anticipated that government spending in 2020 would be in the region of €70 billion. Given all of the decisions that have been made since and the responses that we have had to bring forward, government spending this year will now be in the region of €86 billion, so an increase of 16 billion. And so what I need to do in the next number of weeks, and the work is well underway, is to establish by department exactly how much of that additional €16 billion in public spending will be required again in 2021 as we live with COVID. For example, as we reopen more and more parts of the economy, and I heard Danny's assessment there that about 95% of it is now up and running. We have to ensure that our health service has the capacity that it needs. So in the next few days, we will be announcing the most comprehensive and indeed the most costly HSE winter plan in the history of the state. In addition, our working assumption has to be that there won't be a trade deal between the UK and the EU before the end of the year. And despite the events of this week, in terms of the legislation brought forward by Prime Minister Johnson's government, I think there is still a strong chance that a deal will be done. But we can't plan and we can't budget on the basis of that assumption. So Budget 2021 has to be prepared against the backdrop of COVID-19 still being with us, and also the distinct possibility, if not likelihood, of a no trade deal Brexit. So our priority has to be in that context to support the economy at this time when it really needs it. Our spending choices will need to be wise and output driven. And as Minister for Public Expenditure and Reform, I'm very keen that we move to a point where we have better performance measurement as part of our spending decisions. So in allocating expenditure, I need to know exactly what the public who we serve will get from that extra expenditure. In the Programme for Government, we committed to a recovery fund, and this will feature as part of Budget 2021. I think one of the real learnings from the past 6 months is the need for government to be agile and responsive. We can't predict in October 2020, when we present the budget for 2021, what the economy or the country will look like in 5 months' time, not to mention in 15 months' time. So we need to have a fund that we can use to support the economy in a dynamic way. And resources from the EU Recovery Fund and indeed the Brexit Adjustment Fund can be part of that domestic recovery fund. And so we are really ambitious for this recovery fund, and we believe it can play a central role in our economic recovery. Shortly after the budget, we will publish a new national economic plan, which will set out our approach for the recovery of the economy over the next number of years. This will address issues such as our investment in a sustainable economy, a green economy, our enterprise policies that are needed to support that, the skills development that is necessary in the labour market, and how we can drive innovation. And while protecting and enhancing our FDI offering, putting a renewed focus on the Indigenous economy and SMEs who are understandably struggling the most at this time. The impact that the virus has had on the labour market is staggering. At the peak of the lockdown, the state was supporting, as I said, incomes of over 1 million people. Thankfully, those figures have fallen substantially, in the sense that we now have 220,000 people, still a very, very large number, on emergency unemployment support in the form of the pandemic payment. At its peak, that was 600,000 people. In the last week of August, an estimated 360,000 workers were being directly supported through the temporary wage subsidy scheme, and we have a further 226,000 people on the live register at this time. So I've heard throughout the week, and I've read in the papers, that there's been much discussion about the scarring effects of this crisis on the labour market, and in particular on how it has impacted on younger workers. And we're going to have to pay really close attention to that issue in framing our policy response. If you look at the latest fiscal monitor from the government exchequer returns, the taxes in August in particular, and indeed year to date, there are certainly positive signs there. But you can also see that it has revealed, in relation to income tax, for example, that given that such a huge number of people lost their job and the impact on income tax was relatively modest, that reveals, of course, that people in the service industry, younger people, people in lower incomes, were the most likely to lose their job. And there are lessons there that we certainly need to take account of in our policies. It's very clear that they have taken a hugely disproportionate hit in terms of the effects of this crisis. And so if we were to allow that to continue into the medium term, a whole generation of younger people would be facing real economic difficulties, and that's a massive challenge for this government and indeed for the country. The inequalities that persisted in our society prior to this crisis are still there and will need to be dealt with. And the major policy challenges in housing and in health, those challenges have not gone away. They have been masked over in recent months by the emergency issues, but they have not gone away for sure. We need to ensure that workers who unfortunately lost their job get the training and the skills that they need for a new economy that is now emerging. And that is why we are investing in around 70,000 new places across apprenticeships, in further education, training, reskilling, and back to education places. And that is really important. And that's being rolled out as we speak. Remote working will force us to reimagine what our cities might look like. And as I and others travel in and out of Dublin on a regular basis, it's very obvious to see the effects that are there in terms of the lack of footfall and the impact that that is having on retailers, on restaurants and cafes. And so we do need to take account of the impact on city centres and town centres of remote working, which is here to stay to some extent, but we need to get the balance right, and we need to ensure that there is economic life within our major cities and our town centres as well. And so we need to strike the right balance, and it will be up to each individual sector to decide for themselves what is the appropriate balance between remote working and people working on location. The other issue I want to touch on is the one of international travel. And as a small open economy, an island on the periphery of Europe, it is so important that we retain connectivity with the rest of the world. And the aviation industry is on its knees. It has been devastated by the events of the last number of months. And as a government, we're very conscious of that. We are working on a new plan now, which we will publish next week in relation to living with this virus. And the whole issue of international travel will be dealt with as part of that, because those in that industry need to see a line of sight. They need a level of certainty as to what will influence policy decisions around international travel, and we will intend to give as much clarity and certainty in that plan next week. And the EU will have a huge role to play in that regard as well. And we now have a template from the ECDC in the context of international travel, and that is such an important issue for our country. Just on the fiscal side, and moving to a conclusion, we are expecting a general government deficit this year of between 25 and 30 billion euro. We hope it's closer to the lower end of that spectrum than the higher. But the level of Irish borrowing that has been necessitated by a deficit of that nature is very considerable, and it's on top of an already high starting point in terms of our debt to GNI ratio. And while the ECB's policies are absolutely vital at this point in time in keeping interest rate at historic low levels, we should not view it as an open checkbook. Those policies will not remain in situ indefinitely. They will come to an end, and the markets and the attitude of the markets will be more evident at that point in time. So we can't keep borrowing at the current rate indefinitely. There's little doubt that we will have a significant deficit again next year, and our deficit will fall as time moves on. And the priority for the government is to ensure that we eliminate the current budget balance deficit, and we borrow for capital purposes, and we will be moving to that point over the next number of years, and we'll set out our plan in the context of the budget and the new national economic plan in that regard. But we are also very clear that the best way to close the deficit is by growing the economy. The reason why a gaping hole of 25 to 30 billion euro has opened up is because economic activity was shut down in large part for part of this year. And so we need to repair the damage that has been caused by that and provide the support that is necessary for businesses to get through this really tough period. It does make the spending of taxpayers' money and the decisions that we make at this time more important than ever. And we have to have a laser focus on applying the resources that will enhance the recovery of the economy. And that will be a key test in making the spending decisions over the weeks ahead. So for example, in the July stimulus, we provided a lot of extra money to education, not just because it was the right thing to do to help children get back to school, and overall that's gone really well, but because that has a huge economic impact as well in relation to the ability of parents to go back to work. So that was, I think, a good example of money that was well spent from an economic and a social point of view. It was the right thing to do. Before the crisis hit, we faced huge problems in health and housing. The prospects of young people owning their home had become more and more remote. That problem has not gone away, and it's an issue we are going to have to face up to. In housing and in the wider construction sector, there's little doubt that the viability issue that persisted prior to the crisis will now be exacerbated because many people are on much reduced incomes. The banks are going to be cautious in terms of their lending decisions, and that mismatch between viability and affordability, I think, has become even more acute. And so it is a concern that we're not seeing the pipeline of the number of units coming through that we are going to need in our country in the next number of years. So we do need to examine what policies are necessary to bring about the level of development of accommodation units for the country. So in conclusion, Kieran, these are just some of the challenges that we in government and in society in general need to deal with. In order to do all of this, however, we need an economy that is functioning. We need an economy that employs our citizens and funds the investment in public services. And so to that end, the policy discussion needs to evolve and focus on measures that prepare us for shifts in the economy that will take over the coming months. Policy will need to be responsive. I think that is a really important point, and it will need to target supports to the right sectors. Our future policy must drive growth, jobs, and also develop the long-term infrastructure that our country needs to avail of future growth opportunities. The driving intent of my own Department of Public Expenditure and Reform, and indeed of the government, will be to prioritise the allocation of spending into sectors and services with the most need and the greatest opportunity for growth and job creation. We will need to return to a balanced budget in the years ahead. We will also need to be cognizant of the support that our economy needs to get through this really challenging period. We don't want the damage to be greater than is necessary. While the economic situation is undoubtedly very difficult, there are really encouraging signs about the resilience of the Irish economy that give us great hope and show how far we have come even in a short few months since this pandemic commenced back in February. Since the beginning, since the reopening of the economy, many businesses across the country have returned to trading. Tragically, some have not, and some will not reopen again. But the measures included in the July stimulus, several of which have yet to come on stream, will boost domestic demand in the months ahead. And there's a very important need at this time more than ever for a feedback loop from you as economists, business leaders and academics to us as ultimate policymakers. And events like this workshop are thus of paramount importance as they allow research, views and opinions to feed back into the policy development process. So once again, apologies for being late, and I look forward to the discussion that will continue.
Thank you very, very much, Minister. Thank you. We will move now to questions and answers. We have about 15 minutes or thereabouts for questions and answers. Just before I commence them, I would like to give my sincere and heartfelt thanks to my good friends and colleagues who've soldiered in the trenches to bring you the conference over the last number of years. Jasmina Behan, Yvonne McCarthy, Averick McGibney, Dermot O'Leary, Ronan Lyons, and of course the chair, Barra Rowntree. Thank you very, very much. And most importantly, I would like to thank Maeve at the Trinity Research and Social Sciences and Sarah Condon for their tireless efforts throughout the year. Of course, I would also like to thank the Dublin Chamber of Commerce for being our very generous sponsors for the last number of years. Thank you to the attendees. We have many, many questions coming in. And one of them alludes to Louise's point at the start that there is indeed a tension between short-term job preservation and longer-term allocation. And the question that come in is quite simple, and I would like to put it to all our speakers, perhaps starting in order that you spoke. What might we consider as a viable firm, and where do we draw the line? How long should we have state supports? And do firms not really want grants instead of loans? Louise, if I could start with you, and then maybe Sharon and Danny and the Minister.
Okay, thanks, Kieran. It's a very interesting question, and we cannot tell easily ex ante if a firm is viable or not. But what we can do is basically to make a support contingent on monitoring the state of the firms as they go along. So basically, we don't know. There is uncertainty as to the duration of this crisis. There is uncertainty about the shifts that we're observing in our economies, the sectors that we have ideas about, the sectors that will be booming, the ones that will not. So basically, taking stock on a regular basis about the companies that are benefiting from support, how they are doing financially, how they are performing over time, is part of answering the question as to whether or not they are viable. There are ways of basically, making sure that that companies are part of the solution to this. There's a lot of debate about raising employers' contribution to the cost of the job retention schemes, for instance, paying at least for part of the unworked hours that are associated with that, allowing for differentiated support across sectors. As we see and as the recovery takes hold, the sectors that will be lying behind, what type of differentiated targeted support can be thought of in that case. What are the specific needs for active labor market policies, for retraining, and so on, that will be specific to the sectors where those firms operate. Another option that many countries are thinking about is to basically convert the loans that some of these companies are enjoying now into equity stakes, so that firms don't come out of the period of support with leverage levels or with basically an amount of debt overhang that will then, if not make them unviable now, may endanger their ability to recover later on. So what we've been seeing is that across OECD countries, there is a variety of questions that are being asked and a variety of ways of dealing with some of those issues. But huge uncertainty as to where we're standing now. If you look at a firm, if they are viable or not, it's a difficult question to answer. Hence, the reason why many countries are erring on the side of caution and saying, if we cannot observe with certainty if the firm is viable, let's make sure that there is a support that is provided, and let's make sure that we can then monitor the situation as the recovery takes hold and as we reassess the merit or not of maintaining that type of support, tweaking it where need be, and reviewing and readjusting and adjusting as we move along.
Thank you very much. Sharon, if I may put the same question to you, and are the central bank worried about build-up of debt in certain parts of the economy as well?
Thanks, Kieran, and also to the questioner. So I think on the viable firms, I would agree with what Luis said. It's a very difficult issue and something that's quite challenging to determine. I think the Minister acknowledged there in his remarks that, in fact, there are going to be difficult choices ahead. And these choices about, for example, what supports are provided and to which firms, and trying to make determinations about viability are among those difficult choices. As I mentioned in my own remarks, the starting point of many firms going into this crisis in terms of their own resilience, whether that's in terms of cash flow or their existing exposures to debt, are certainly a factor. I think an important aspect is the way in which the supports are also operationalised. So banks clearly know the firms that they've lent to the best, although in Ireland there are a large number of SMEs who don't have an existing relationship with the bank. So that could be one of the challenges because many of them don't have debt. But state agencies like the Strategic Banking Corporation of Ireland and so on, who will provide some of the supports and deal with some of the schemes, I think have a very important role to play in supporting some of those processes. On the latter question about the kind of indebtedness levels overall, I think this is something that is of general concern to the central bank, and even prior to the pandemic, it was still the case that in Ireland, particularly, for example, households still had significant levels of debt by comparison with other EU countries. So we are conscious of that being one of the challenges going into this crisis in particular. It's why rules like the mortgage rules, for example, I think we see them as being so important. As I said in my remarks again, particularly I think on the government side, some of what the Minister said about the sustainability of debt into the long term, I think that's true not just for the government, but also how we'll be thinking about the indebtedness levels of the corporate sector, of households and so on as well. Thanks.
Thank you, Sharon. Danny, in putting the question to you as well, can I add a little bit? Is there any way, or do you think we need extra incentives in order to put this extra household savings to get consumers to spend more? I know we have an initiative, a tax rebate initiative here, but do you think we need something like they have in the UK, such as the Eat Out to Help Out scheme?
Yeah, I think there are probably innovative ways to think about this. Just on the first part of the question about viability, I think that's the viability is always a kind of a veil of ignorance. But we have to, on this occasion, this is not a cyclical downturn. This was a deliberate closing down. So, like to paraphrase Spike Milligan, all they seek is the opportunity to show money can't make them happy. All right, and so what firms are looking here for is the opportunity to show they're viable or not viable in this new world. So as a society and as a state, we shouldn't be trying to pick winners or losers right now, but to give them the opportunity to open up and to give them the grants, not loans. But what Sharon made the point there more long-term, the lack of indebtedness is not a good thing. It can show a paucity of ambition as well. And that may be understandable given the crowding out effect that the really large scale investment that's going on from the phenomenal change we're occurring here. A lot of SMEs will be crowded out from getting at the kind of property assets for commercial building or for the type of talent because of this unique economic speak, this kind of Balassa-Samuelson effect we're getting from a traded sector to non-traded sector occurring. So we need to frame for the Ireland that is right now, not other jurisdictions. And on that latter part, there must be smart ways of getting the households part of the solution. If people don't want to be faced with taxes or we're not willing to confront them with taxes, can we think of more innovative schemes like we did previously, like SSIA type activity that actually channels, not on that occasion for just mere saving, but savings with a purpose. And we can see that with the, on a merit good, like our university rankings is a clear example. Are Irish people actually interested in education, or was that all just pie in the sky? Because we have a serious issue in terms of our branding. People might say they don't like rankings, but let's say that we actually have a bond for the universities is actually financed out of the Irish households with a proposition it gets paid back, but the resources that are currently lying 120 billion in savings, can some portion of that be put for what people actually want and need? And that doesn't just be about universities, it can be on other merit goods like housing, transportation, sustainability, etc.
Thank you very much. And Minister, in posing the same question to you, is there a fear of the European Commission given any indication as to what our treatment would be vis-a-vis our debt levels?
Sure.
Reducing our debt level.
Sure. Just to take the initial questions first, when it comes to the question of viability at the level of an individual firm, I think a starting point would be that a business that was viable prior to COVID should be given a fair crack of the whip and should be given support for a period of time. It's another question as to how long you provide support for. So just taking Sharon's point there, I think a lot does depend on what the starting position was going into this crisis at the level of the individual firm. What was the underlying health of that business financially? Economic growth was slowing anyway coming into this crisis, but it was still quite healthy and quite strong. There were pressures in individual sectors, but I think if a firm was viable 5-6 months ago, then I think we do have a duty to provide support to them for a period of time. The question of how long we can provide that support is a difficult one too. As I say, from a government perspective, we are bringing forward the National Recovery Plan. The budget next month will be about supporting the economy. Decisions have already been taken to extend certain supports right out to the end of next March. And we do stand ready to do more to support the economy. So it's something that remains under constant review as to how long the supports can be given for. I do think that from the point of view of the financial system, and when the payment breaks expire for businesses, those that took the 2-3 month payment breaks, many of them are expiring around now or next month, that may put them under pressure, depending on their ability to negotiate a restructure or a further forbearance period from their lender. And so that may reveal underlying difficulties for businesses depending on the outcome of their negotiations with their lender. So I think that will be a critical issue. On the issue of providing loans and not grants, we're trying to do both as well as we can. The new €2 billion credit guarantee scheme, is being 80% guaranteed by the state, which is a very significant level of commitment by government for guaranteeing 4/5 of each individual loan. And the corollary of that then is we expect the banks to lend at reduced interest rates, and those products are now being rolled out. I think it is an open question as to what the level of appetite is among businesses. It's probably not great to take on additional debt, I think it's fair to say, but for some of them it will provide an opportunity for refinancing, for taking on additional borrowing to sustain their business. And then when it comes to ensuring that we are extending the support to the right businesses, it's easy enough to define those that shouldn't get it, as in that they don't need it. Those that are already doing very well, you can put in, you know, percentage turnover reductions and so on, as we have done in certain schemes. It's more difficult to define those that shouldn't get it at the other end of the spectrum because they're too weak. But I think over time that will become more clear. But the key issue is about restoring confidence. And I think for the business community and for the general public, if they see that there is a plan for the next number of years, starting with, you know, very much a pro-enterprise budget for 2021, I think that will help to instill confidence and will hopefully encourage people to start spending more money and to stop the trend that we have been seeing of massive build-up of deposits and savings.
Thank you. Thank you for Danny. A lot of questions for you. If I may, one in particular, Danny McCoy points out the need for public sector spending on a variety of issues. Does he think that tax rates have been raised to pay part of the pandemic costs? Does he think that tax rates should have been raised to pay part of the pandemic related costs rather than the temporary VAT rate reduction that has just been brought in?
Yeah, look, I think this is I think a mandate for the Commission on Taxation and Social Welfare, because I think it does need to have both parts. Having been on the previous commission, I thought the welfare part of it being left out of it made it like a one-armed bandit, so to speak. Clearly the rebalancing towards the state being able to fund and finance what are fundamentally collective goods is going to require more contribution right across. And I think that those who have heard me maybe in public talk about social dialogue is that the employers are being hit by a whole lot of costs in the labour market at the moment, which may well be best bundled into one direct mechanism, because right now we're getting the sick pays back on the table for everybody, the parental leaves are additional costs. You know, there's a lot coming through private member bills that actually do add to the wage bill. And the wage bill is going up and the private sector wages are going up as well. But people come looking for higher wages to compensate for the lack of housing, the commute times, all this pre-COVID, obviously, commute times, etc. We need to break that circuit break. We need to start delivering those goods. And taxation or some more innovative ways of extracting the money, even borrowing it from the households, would make sense.
Thank you. Thank you, Danny. And a final question, if I may, and Minister, there's a lot coming in on this one. In the present cheerleading for even more public borrowing, there are predictions of an extra 12 billion in capital spending as an extra stimulus. I think you mentioned 9 billion yourself, Minister. This boosts again a construction sector which has had no increase in productivity for 2 decades, and it has given us a lot of expensive capital project. After 70 years of public capital program expenditure, is it time for more economic rigor in its spend?
Yes, we need to do both. We need to be rigorous in our assessment of projects and the cost-benefit analysis and around the procurement and the managing of individual contracts. But I think it is absolutely the correct policy choice to spend on capital infrastructure. You know, we are able to borrow now at historic low interest rates. We will spend €9 billion next year. We'll set out a window of investment for a 10-year period, giving line departments, as I said, certainty for the next 5 years. Like, there is so much unmet need, whether it be around water infrastructure, wastewater, renewable energy, housing, transport projects. There is so much that needs to be done, and I think this is an opportunity to get it done. We need to make sure we get value for money. It is quite possible, depending on the fallout from COVID-19, that some capacity in the construction sector that was being used to build offices or build hotels might now become available for more public infrastructure and indeed for housing. So that is an issue that I think we might be able to get some benefits from. But I really do believe it is the right policy choice to invest now. And I think it was one of the mistakes, and I'm not saying there was much of a choice 10 years ago, but capital investment was slashed by about 60% from peak to trough. And that meant that projects were stalled, and they weren't there. Even now, when I'm looking for projects that we should be spending money on, many of them are stuck at planning, design stages, judicial reviews, and we do need to find a better system of advancing projects through the various stages. Kieran, I didn't mean to not answer your question earlier on about the deficit in the European Commission, but just very briefly on that point. So we are, forecasting a deficit this year of in the region of 8 to 10% of GDP. Hopefully at the lower end of that. That would probably put Ireland mid-range in terms of other European countries. The requirements of the Stability and Growth Pact and the normal discipline has been suspended by the European Commission. That's not going to last indefinitely for sure. And we will be setting out a pathway for deficit reduction over time, ultimately moving to current budget balance, then down to below 3%, and ultimately a balance in structural terms. So we will set out that plan, but the best way to do it is to grow the economy. And one thing that Minister Donoghue and I have consistently said is, we don't want to stand out from the crowd when it comes to our deficit. We don't want to be higher than everybody else, so that when the ECB does change its policies and the markets are taking a very hard look at individual countries and their debt sustainability, we don't want to stand out as being a country facing huge difficulties. So we do want to bring it down. We're going to seek to do so by growing the economy. We have a high level of national debt. By the end of this year, it will be in the region of 125% of GNI star, which is a much better measure than GDP in terms of measuring our debt sustainability. So we're determined to set it in the right direction. But for now, the focus is on supporting the economy, growing our tax revenues, and supporting people at work.
Thank you, Minister. And thank you very, very much to our attendees for their many questions. I was posing the questions as they came in. I would invite the speakers if they would like to make any final comments. Louise, would you like to make a final comment? Or?
Kieran, very briefly, I think this has been a fascinating exchange. We are going through a period of very exciting, intellectually speaking, period for all of us in the policy area to basically make sure that we can combine or reconcile the need for short-term support and protection and rescue of businesses and people, move on to the next phase as we go along, and a lot that will determine the performance of our economies and societies over the longer term will depend on the measures that are taken today. So opportunities like this one to exchange on what works, the specific challenges of countries and the commonalities that we see, because there are many in many parts of the world, that will certainly be a very important element into the decisions that governments will make. So congratulations on this, and a great pleasure to have joined you.
Thank you, Louise. Sharon, would you like to make a final contribution?
Well, maybe just to thank you again, and then I suppose to emphasise, if you take my presentation in the round and some of the issues that we've been talking about, certainly from the perspective of us here at the Central Bank. I mean, we see our role very much about financial stability and the long-term economic health and resilience of the economy. As I said, we've done a range of things, including some of the things that the Minister mentioned there in the context of monetary policy, as well as a range of other policy measures, I think, that have been very focused on that. There are many challenges ahead. Not just from the pandemic, but climate change, Brexit, and so on, some of which have also been touched on. And we'll continue, I think, to see a very important role for central banking policy in that context, in trying to build this longer term resilience and avoid any amplification of some of these stresses and strains on the economy. But it's been a pleasure to be here, and thanks as always to the DW.
Thank you so much, Sharon. Danny, would you like to make a final comment, please?
Yeah, thank you again, and thanks to the Minister as well, to the fellow panelists. The last point I want to really say is just repeat something. As economists, sometimes we forget that the investments were made 3 or 4 years ago still exist. So as a business community, they're in the ground, so to speak. They didn't invest them in Ireland to sink them and walk away. And so they're recurring income, and they have life cycles. And a lot of those life cycles are quite long in pharma and including in tech like data centers, etc. And they will be reoccurring for quite a number of years. So there is a huge window of opportunity here where the Irish economy will generate resources. But we've already into year 6 of it, and whether we've actually put in place a sustainable proposition is the question mark. But let's make sure that we don't waste the next period of time without getting those kind of merit goods in place I talked about earlier.
Mille buíochas, Danny. Minister, would you like to make a final comment?
Yeah, sure, Ciarán. Well, look, first of all, just to thank you and thank all of the organisers and those involved in my own department who contributed so much as well. And I look forward to looking back over the presentations that I haven't had an opportunity to see so far. But I would just encourage all of those who are online to continue to engage with the public sector and engage with my department and those of us who are directly involved in policy making. Your inputs and contributions are always welcome. We may not always be able to follow through on what you're suggesting, but we do want to hear from you. And I think that's an important message to convey, is that, you know, we do want you to reach out. It's an exceptionally busy time in government. We have the new plan next week, which I think is really important, not just in managing COVID, but in also providing certainty to people about how our economy can function alongside COVID into the future. And that, I think, will provide much needed clarity and will hopefully help in the recovery. We've got the budget on the 13th of October. We'll have the commencement of the National Development Plan review. We'll have the new National Economic Plan, which we'll probably publish in November, and all the while we'll be supporting the EU negotiators in terms of getting the best possible outcome to the Brexit negotiations. So there's a lot at stake and a lot in play at this point in time for our country, but all of the decisions that we will make as a government will be about supporting the economy and supporting enterprise and those that are providing employment that can sustain people's quality of life. And, you know, that is ultimately what we're trying to achieve. Thank you.
Thank you, Minister. A heartfelt thanks to our speakers from the Dublin Economics Workshop, Buíochas Ó Chroí, Liv Golair, and of course to all our attendees. We hope you enjoyed today's session. Remember to join us at 1 o'clock tomorrow for the second part of this question, how can policy aid the recovery? And of course, at 4 o'clock for that thorny old chestnut, is Ireland a tax haven? Gur míle mágaí go léir, go dtéas sibh slán.